The bond market is changing, with regulations and technological developments drastically altering the playing field. So is the market still a sound investment? Frederic Ponzo from GreySpark Partners joins me now to discuss. Frederic, investors are still sitting on cash, and yet fixed income bonds are pretty safe. Is this because of fairly high associated fees, or perhaps a wariness still in the market?
The issuance of corporate bonds has been going through the roof since the financial crisis. The stock of corporate bonds in circulation has increased by about 50%. The investors, the buy side, are actually holding more bonds than any other type of investor. So if the question is, are investors worried in putting their money in the bonds market? The numbers are proving the other way around.
How would you say changes in inter-dealer trading influences change the market?
Essentially what's been happening since the new regulations have been designed, not all of them have been implemented as a matter of fact, is putting an increased number of restrictions and capital charges on the dealers' ability to put money at risk. As a consequence, they had to reduce the size of the inventories of corporate bonds in particular, but bonds in general, they're keeping on their trading books. And because up until now, the only liquidity provision mechanism which has been used by the market to buy and sell and essentially manage the time mismatch between the moment an investor wants to buy paper and another investor wants to sell the same paper, has been using the bank's balance sheet. Those warehouses, those trading books, those inventories have been dramatically reduced by about half of their size. All of a sudden, liquidity is freezing out. That's the real stress in the bonds market today.
But how do government bond markets, they're traditionally a safe market, alter corporate bond markets?
The core government bond market, so I'm talking about US Treasuries, I'm talking about core Euro govies or Japanese government bonds, they're still seen as safe. However, the extraordinary monetary policies which have been driving the yield on those bonds quite dramatically, below zero in real money terms, below the inflation rate, have essentially also increased the price of the corporate bonds asset, i.e. reducing the yields on those corporate bonds. Now, we are coming to a point where some of the central banks are about to reverse their monetary policies. So we had the tapering in the US. We expect the first rise by the Fed before the end of the year. The Bank of England will probably follow suit in short order, which means the yield on the corporate bonds will increase and their price will decrease as a consequence.
Recently, we've had a massive influx of regulations that have changed the investment landscape. Where do you stand on MiFID, Basel III and the like? Are regulations strangling growth opportunities?
The point of the regulators is not to foster growth in the bonds market or in the secondary market. Their job is, first of all, prudential, is to make sure that the market structure is safe and sound, and second of all, to guarantee fairness and transparency in those markets.
When I've been interviewing people, I've heard a lot that they're all saying regulation has gone too far, it's really tough on the market. You don't think it's gone too far?
The regulations which is put in place today by the regulators is based on legislation which has been designed a little bit in anger 4 or 5 years ago by the legislators. Whether or not they've gone too far, it's a question, it's a philosophical question, as a matter of fact, but that's the will of the people to a certain extent. What is true, though, is there are essentially 3 pushbacks which are absolutely valid. The first one is a lot of those regulations have been drafted in a hurry and they've been badly written. A piece of regulations like the Dodd-Frank Act, which is spanning hundreds, if not thousands of pages, can't be a template for sound and efficient regulation. The second thing which is true is, despite the G20 agreements and the coordination with the various regulators, the main regulators, there's been a little bit of a contest between various regulators trying to outdo each other. This is calming down. And this is also true that a lot of regulations tend to overlap and at the margin to contradict themselves. So we are definitely we've reached the tipping point of more regulations in terms of complexity of those texts and rules. I don't expect any rollback. I do expect a pause, and I do expect a phase of simplification to make them more manageable.
Finally, do you think changing attitudes towards risk and risk management have changed attitudes towards corporate bond markets?
Behaviors tend to go in one direction following the herd. Risk on, risk off. I buy, I sell. Everybody buys at the same time. Asset prices are going up. Everybody sells at the same time. There is no buyer, and finding a bottom price for those assets is difficult, and there is a vicious circle because you mark to market your positions and you need to raise some more cash in order to cover that risk, and therefore you need to sell some more. So yes, definitely, that's one of the big challenges. In Europe, you could argue that for now, you still have a buying of last resort, or at least in the Eurozone, and that's the ECB. As part of their quantitative easing program, they're buying corporate bonds on a monthly basis, and actually the main limiting factor to complete that QE program is the availability of paper. So you've got that floor on the bonds prices, euro-denominated bonds prices. In the US, that's not the case anymore. In sterling, that's not the case. The BOE never bought corporate bonds. Ultimately, we are pretty much at the top of a bubble. What goes up needs to go down. The way it's going to go down, as headline interest rates are progressively going back to normal, is a function on how orderly the market will be structured. And yes, that's a challenge.